What's up, everyone? It's Scotty with Money Investing. So, Goldman Sachs recently came out with a report suggesting that this earnings season or earnings recession, which is going to unfold, is going to be just as bad as what we saw during the pandemic back in March of 2020. So hope you guys are doing great and are having a great long weekend. If you guys enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below. And don't forget, there is a fundamental and technical analysis coupon code Easter that is 60% off, that does expire tonight. So if you want to take advantage of it, it is going to be gone after today. And that's the bundle that's currently 60% off, and link's going to be down below. So first things first, let's just quickly break down the US profits, which are set for a pandemic-sized drop, Goldman Sachs says. And further going on by mentioning that this year's 20% rally in US technology stocks is decoupling from reality ahead of what's predicted to be a gloomy reporting season. While investors have flocked to tech in the market shakeup amid recent banking turmoil, the rotation is at odds with analyst calls for the steepest drop in quarterly profits for the sector since at least 2006. Nearly 60% of 367 respondents to the surveyed by Bloomberg said the bounce in the shares had nothing to do with earnings expectations. And that really is very, very important, because one of the things that we have talked about on the channel is the distinction between technicals versus fundamentals, right? The technical rally completely based on oversold conditions, completely based on this sentiment, and of course the rotation out of banking, out of some of the other sectors that were feared at the time, and more concentration towards big tech, something that I've done videos on, concentration risk, because we haven't really seen a very broad-based rally from the market. Instead, what we have seen is a very concentrated rally with a handful of stocks really pushing higher, of course taking the S&P 500 higher with them. It all really at the end of the day comes down to earnings. Is something, again, I've mentioned before, is that everything that we analyze, from interest rates to economy to unemployment to GDP, everything, it all trickles down to the bottom line, and how are the earnings going to fare up in all this uncertainty that we have going on. Of course, this upcoming week we've got inflation, and earnings season does begin on Friday with a lot of bank stocks reporting their numbers first, and not to mention big tech is going to be reporting at the end of April. And I do personally believe that we are going to, on an aggregate basis, see a bit of a decline on a year-over-year basis. In Q4 of last year, we already did see a decline of close to 1 to 2% on a year-over-year basis. And this quarter, I think the expectations are as much as 5 to 7% year-over-year decline, which obviously could put some impact on what the earnings are going to look like moving forward in 2023, and of course would kickstart an earnings recession, because we'll have 2 consecutive quarters of earnings decline on a year-over-year basis. And I do also personally think and agree that the rally that we have seen has a lot to do with more sentiment and less fundamentals for the market. Now, this right here is a team of analysts, a team of Goldman Sachs analysts see hope for individual companies that could manage to buck the trend by delivering on 4 areas of critical importance to investors. Analysts cut their outlook pretty aggressively as the economic outlook deteriorated during the first quarter, and as a result, operating profits are expected to have shrunk by 6.8% last quarter, according to an average Wall Street forecast compiled by FactSet. So this right here is really what the year-over-year growth is going to look like for EPS, earnings per share. And again, fourth quarter, 1%. And in the first quarter of 2023, we're expecting to see at least a 7% decline in earnings on a year-over-year basis, and that number is going to accelerate to over 6%, actually a little bit over 6% in the second quarter, so 3 quarters in a row, and that is most likely going to be an earnings recession. That is a more technical definition of an earnings recession if they are coming down on a year-over-year basis. Now, we would have started that earnings recession last year in the last couple quarters if it weren't for energy. Energy had a pretty substantial outsized gain on a year-over-year basis. Like it was growing like a triple digits, 100, 150, 200%. And as a result, kind of had like an outsized gain for the S&P 500 on an aggregate basis, kept the year-over-year gain pretty elevated at 10 to 4%. But since oil prices have declined by over 40%, although there are some expectations that oil prices are going to recover back in the summer and towards the back half of this year. But as they have come down, energy companies are also seeing lower revenues, and comparables are also much difficult to beat for those companies. So expectations are for us to see 3 consecutive quarters of decline on a year-over-year basis, which is most likely going to kickstart this earnings recession. Now, earnings recession doesn't always necessarily mean that it's going to lead to an economic recession. This right here is a chart that pretty much mentions or pretty much goes over every time we have seen an earnings recession in the past. This is literally all of the earnings recessions, and the shaded area are kind of coinciding with an economic recession as well. So the red circles are both earnings and an economic recession, but the green circles are only an earnings recession, not accompanied by an economic recession. So what you'll notice is that in 2016, 2014, we have seen earnings decline, earnings recessions, in other words, 2 consecutive quarters of declining earnings on a year-over-year basis, but they were not accompanied by an economic recession. And 2019, 2020 is not part of this because this is a little bit older, but you'll also put a red circle over there because we not only did see earnings recession, but we also did see an economic recession back in 2019, 2020. And of course, 2023 is going to be a big question mark on this chart because we don't know. I mean, earnings recession, I'm pretty sure that that's going to happen, but economic recession is still a bit of an uncertainty with respect to whether it's going to happen, if so, how severe, and if it's going to happen, when is it going to start. All those are still question marks at the moment. But most of the times, if you notice, 1, 2, 3, 4, 5 times out of the last 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 17. So 5 times out of the last 17 times is the only probability that we have seen an earnings recession without an economic recession. That's only happened 30% of the times going back as far as 1948. So we are going back almost about 100 years, 90 years to be precise. We're going back to figure out, okay, what is the probability of an earnings recession creating an economic recession moving forward as well. And as I already mentioned, the economic recession probabilities are also substantially higher for the markets. Now, I also want to point out that the probability before 1982 was actually a lot higher in terms of economic recession and earnings recession for both of them to happen, because past 1980s, I mean, we have used quantitative easing measures. Monetary policy has been a little bit more active in market fluctuations and market manipulation, so to speak, because QE has always stepped in, even at the slightest of risks of an economy going into a recession. QE has stepped in. So if we have seen consecutive quarters of decline in earnings, QE or monetary policy, I mean, it's been shaped in a way that has supported the economy and prevented those economic recessions. So in the past, you'll notice that that was a pretty high probability. If you actually saw earnings recession, it was also leading up to an economic recession, and they both happened at the same time. But more recently, though, you'll notice that they have kind of pivoted a little bit away because of QE and all the monetary policy measures. This right here is another really good research that was put together by NBER that put together going over the previous recessions going back as far as 1945 and how much the earnings per share decline really was. So what you'll notice is the median decline during an economic recession, which lasted about 10 months, was about 18.4%, right? 18.4% was the median decline, with an average decline of 26% in earnings. So the real question for this one really is whether we're going to see an economic recession or not. In my opinion, with all the other leading indicators that I'm following up with, at the end of this year, early next year, there is high probability that we do see one. And that could also result in earnings to be lower because of a lower consumer spend to begin with. It's actually going to be a good thing for inflation because people are not going to be spending as much, and inflation is going to rotate back lower, but it's not going to be so good news for the actual earnings for companies, for S&P 500 companies. So those are some things to pay attention to because, it really is going to eventually trickle down to earnings and how they're doing and whether they're able to grow or not. And we already know the expectations for the next at least 2 quarters is for us to see a decline, and the earnings season is just getting started here on Friday. So let me know your thoughts down in the comment section below. Now, I'm not saying that this is going to strictly be bearish for the market, because market is very much, almost always trading on a whole completely different tangent because it's disconnected with the reality, disconnected with the economy and all that stuff. So if there is more sentiment driving the markets higher based on this idea that if there is an earnings recession, there's going to be an economic recession, the Federal Reserve is going to start cutting rates, that is actually going to be ending up bullish for the market. So just because we see an earnings recession, economic recession, does not necessarily mean that that's going to be immediately bearish for the market and stocks are going to sell off. It could actually end up working the other way around, could end up being positive for the market as a lot of QE steps in from the Federal Reserve and they once again start cutting rates. But that, in my opinion, is going to be more or less positive for the short term. But in the future, sooner come later, we have to face the reality, which is the economy and the condition, the strength of the economy, and how well the earnings are shaking out in 2023. Eventually, we have to face the facts, face the reality, which is going to not be so good for the markets, in my opinion, over the longer term. So I hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below. Let me know your thoughts down in the comment section below. And as always, happy investing, and I'll see you all in the next video. Don't forget the Fundamental and Tech Analysis courses, the bundle, currently 60% off, and the coupon code is going to be Easter. So always happy investing. I'll see you all in the next video.